Hello everyone, I'd like to welcome you to the first video of a weekly series I'm developing for realtors to keep them in the know as to what is occurring economically, what housing data is coming out weekly, what's going on with interest rates, anything you need to know from an economic perspective to provide the proper guidance for your clients. You will receive weekly with these videos. I'm going to try and keep them short, hopefully 2 minutes to 2.5 minutes, so they don't take up too much of your time, but they'll be action packed with the right data that is necessary for you to kind of formulate your own opinions as to what is occurring in the local housing market, as well as macro level economically. First, I want to show you the chart, 2-year chart of the mortgage-backed securities. This is exactly how interest rates are set by all lenders. Something that you'll find interesting would be right here at this level where my cursor is, when Ben Bernanke mentioned that they are going to start tapering down the bond buying program. We broke below this blue line, which is a 200-day moving average. From a technical perspective, whenever the 200-day moving average is violated, there's selling pressure that normally follows through, and that's held true back in May, and we saw rates just increase by a percentage point in a quarter up until this point where we had a Fed meeting, and they decided not to taper at the last Fed meeting. Bond traders enjoyed that news. Bonds have been rallying, and yesterday we actually broke back above the 200-day moving average, which we failed to do so the couple of weeks before that. So what does that mean from this point forward? This means rates will decline in the near future. We're going to see rates probably decline by another 1/4 to 1/2 percentage point from these levels. Currently, we are right around 4 1/8, 4% mark, 4 1/4. Pretty much depending on the rate sheet, depending on the day. More than likely, if I draw a line here, the next true ceiling of resistance, which will keep rates from dropping further, is this 106 mark. But if you notice right here, this series of consolidation on pricing, going from this point back in January, March, and most recently May, that will serve as the next ceiling of resistance. Sorry about this. Let me get back in there. So what happens when you share your account with other people. Let me go back to 2 years. And let me draw the line one more time. So right here. Here's where I expect kind of rates to probably level off and not decrease any further. This is not going to be a straight line. We're going to go up and down a bit. But I do believe we're going to probably reach the 3 3/4 mark, especially on government FHA loans before the end of the year. So that's what's occurring, from an economic standpoint in terms of interest rates. Now, will rates stay at those levels? Probably for the next 3 to 4 months. We'll probably enjoy the range bound of rates between 3 3/4 to 4 1/4 percentage points up until March, which is where a lot of traders now expect the bond buying program, which has been keeping rates artificially low, to start being withdrawn from the system. I don't think that's going to happen come March. I think it's going to be more probably Q2 of next year. But if traders believe it's going to happen in March, they're going to start selling bonds ahead of it just because they perceive it will occur, and that will create rates to increase. But time will tell. We're still months away from that. One chart I wanted to share with you real quick, if I could just find it here. Again, there we go. Is the latest FHFA home price that came out today. As you can see, from May of last year, 2011, pricing has been gradually increasing. And here's a great chart to share with your clients to show them that the market is appreciating. It's getting better. Home prices gradually increase. Obviously, we're in Connecticut, which is a judicial state, so we kind of lag behind when it comes to pricing going up and pricing going down. And I do believe we're at the beginnings of home price increasing in the local Connecticut market. And I think next spring market is going to be very robust. But just to be ahead of the curve, to present this data to your clients. This is a great chart to share with them. So that's all for today. I'll try to keep this a little short. I'm going to provide more data as it pertains to unemployment figures and GDP figures next week. Thank you very much. Bye.